I'm Grant Walker. Welcome to Last Call for Thursday, the 28th of May. I'll be back with Heads Up tomorrow morning, Friday at 10 a.m. To Auckland Housing. Auckland Council efforts to increase the number of properties eligible for a new fast-track resource consent process haven't yet extended to building apartments, even though the Reserve Bank sees high-rises as key to easing the housing shortage in New Zealand's biggest city. To reduce red tape, the city's Building Control Department has introduced risk-based consenting for minor building work, terraced housing built to standardised plans, and launched a scheme allowing consents from accredited firms for certain building types to be fast-tracked. Those efforts were applauded in a report by the Auditor-General into how the council handles consenting processes. And the government watchdog recommended the city expand its fast-tracking processes. Auditor-General officials yesterday briefed Parliament's Finance and Expenditure Committee on its report. Asked if the council was taking steps to speed up consenting for apartment buildings, Sarah Lynham, the Auditor-General's Sector Manager of Local Government, said the risk-based consenting for terraced housing crossed into that territory, but in respect of 10-storey high-rises, she said, "I don't believe there's a particularly risk-based sped-up process for that style of housing." Earlier this year, Reserve Bank Governor Graham Wheeler told the same committee that height restrictions on inner-city dwellings and the pervasiveness of the not-in-my-backyard syndrome were undermining efforts to address a supply shortfall of between 15 and 20,000 properties to meet population growth, while new consents at an annual 7,500 were lagging behind the 10,000 needed. Green Party co-leader Russell Norman said his view was that apartments are the building solution to supply side. There's no way you can win this thing with sprawl. Auckland Council's risk-based consenting covered three types of consents: minor renovation work such as installing fireplaces, which aimed for a same-day turnaround, a standard dwelling program for 18 accredited firms with 5-day processing, and the multi-unit terraced housing consents facing a 10-day wait. Asked whether the Auditor-General had seen any variance in the government's special housing areas, Ms Lynham said it was too early to tell. Auckland Council is the country's biggest accredited building consent authority, processing more than 17,000 applications a year and carrying out some 148,000 inspections. To market results, Argosy Property reported a 25% drop in annual profit while its rental income rose as the listed property investor returned to a tax-paying position for the first time in 4 years and paid more interest. The Auckland-based company said in a statement profit for the year fell to $64.4 million in the year ended March 31st from $85.6 million a year earlier. Distributable income, the preferred measure for property investors as it strips out unrealised movements in fair value, fell to $48 million or 6.02 cents a share from $50 million or 6.69 cents a share. The company's bottom line was weighed on by a $23.2 million loss on derivative financial instruments compared to a gain of $20.6 million the year earlier, which Argosy said caused a loss on its interest rate swaps due to the lowering of the interest rate curve during the period. Argosy said distributable income dropped after the company faced an $11.6 million tax expense, the first time since 2011. Net property income rose 11% to $90.9 million as it benefited from acquisitions in the year, and a refurbished Stout Street office block came online, starting a 12-year lease with the Ministry of Business. The board declared a final dividend of 1.5 cents a share, taking the annual payout to 6 cents in line with guidance. Argosy shares rose 0.5% to $1.11 and have gained 2.3% since the start of the year. The stock is rated an average hold based on 5 analyst recommendations compiled by Reuters with a median target price of $1.13. The property investor has been diversifying its portfolio outside Auckland, focusing on industrial sites rather than malls and retail investments. Last year, it identified $70 million worth of property to divest. Argosy bought 5 Lower Hutt sites for $59 million in the year, marking its first Wellington-based industrial site renting foray. Across its 68 properties, which have a market value of $1.3 billion, the occupancy rate was 99.2% with a weighted average lease term of 5.54 years. About 39% of the portfolio is industrial, 37% office space and 11% retail, while the weighting to Auckland was 65% and 28% in Wellington. Of its properties, 83% are considered core, 11% were value added and 6% of properties or land the company is looking to sell. In business news, Air New Zealand has a luxury top-of-the-line exclusive lounge area it reserves for its most prominent flyers hidden in Sydney Airport. But to be able to enjoy the benefits of the lounge, a passenger has to be an Elite Priority 1 member. Elite Priority 1 is a step above Air New Zealand's Elite 10 Club, where the customer has to have been a member for 10 years or more. An Elite Priority 1 membership is available only by personal invitation from Air New Zealand's Chief Executive, Christopher Luxon. Air New Zealand revealed to NBR Radio this luxury area is located in the new lounge in Sydney Airport and is reserved for Elite Priority 1 members and their guests. Last week, Air New Zealand revealed its new more than 15,000 square metre lounge design in Sydney Airport. The new lounge, located on level 2 of the international terminal, has a bar, a range of cafes, a kids zone and apparently tucked away the luxury lounge for Elite Priority members. A spokeswoman for Air New Zealand says Elite Priority 1 is an invitation-only membership program for our most frequent flyers, which has been running for more than a year. While we won't discuss the specific criteria for Elite Priority 1 membership or benefits, the program has been designed to recognise those who travel with us most often. Despite this, it's rumoured a host of top New Zealand executives as well as some of New Zealand's university chancellors are on its guest list.
NBR Radio. With Clooney Restaurant now offering Auckland's most exclusive private dining room. NBR Radio.
This is NBR Radio, Thursday, May 28th. I'm Owen Poland and welcome to the weekly edition of Media Watch. I'm sitting with reporters Campbell Gibson and Nick Grant, and today we're looking at the death of Campbell Live, the bickering of ad agencies, Sky TV investor updates, and MyRepublic giving up the fight for global mode. This week, NBR revealed that small ISP MyRepublic has given up its battle to defend global mode, the geo-blocking workaround that allows New Zealanders access to international sites they wouldn't normally have, such as the American version of Netflix and Hulu. So, Campbell, firstly, why did MyRepublic throw in the towel?
Well, the wider context here is that as soon as the big four media companies, Sky Television, MediaWorks, TVNZ and Spark, which owns Lightbox, announced that they were taking legal action against the ISPs that were using global mode, a bunch of them folded and basically gave up just because they couldn't afford it, basically. And MyRepublic initially stood by Core Plus, which is sort of the one that's championing this movement, and Core Plus owns Slingshot, Orcon and Flip. So MyRepublic, initially stood by Core Plus, but now, this news this week has seen them sort of give up the fight. And they haven't responded to NBR queries as to why they've given up yet, but it's certainly, I would hazard a guess that it'd be the same reasons as those other smaller ISPs.
How does this bode for those fighting for global mode?
Well, it doesn't necessarily mean that they think they have a weak legal argument. It's, like I said, the fact that they probably don't have the time or the money to be able to fight it. And it's anyone's guess as to who's going to win global mode. The law hasn't quite caught up, as we all know. So it's going to be, I think it'll be a legal case that'll be dragged out quite a bit. And we're still waiting for a date, so we're still waiting for that even.
Now, turning to Sky Television, which, as we all know, is facing increasing competition, Nick, but I understand Chief Executive John Fallett was upbeat about the company's prospects when talking to investors this week.
Yeah, that's right. After many years of essentially having the subscription television segment of the market tied up in New Zealand, Sky is facing competition from the likes of Spark's Lightbox and the entry of services like Netflix into New Zealand. But John Fallett was upbeat. He said that there are more opportunities than threats represented by video streaming, and that although Sky, in order to combat that competition, is going to have to spend sufficient funds that it means they can't raise their dividend as many shareholders would like, they are going to maintain it at the current 70% of net profit. Now, Sky's been making quite a few bold moves in recent times to really buttress its incumbent position in the marketplace. It was announced this week that they have tied up the rights for the FIFA World Cup, that's the Football World Cup, for 2018 and 2022. They also announced in the past couple of days that they are going to make the Season 2 of A-list HBO series True Detective available on their new streaming video-on-demand service Neon the same day as episodes screen in the US, something that Sky had already done last month with the hugely popular Game of Thrones. So it's interesting. Sky is very confident of maintaining its commanding position in the marketplace, and with these kind of moves, I think they've got a good chance of doing so for quite some time to come.
Okay, back to you, Campbell. On Tuesday, independent ad agency Contagion announced that it had won the Harcourts advertising account, with rivals Saatchi & Saatchi and Ogilvy and Mather also said to be in the pitch. Why did that stir things up in Adland?
Yeah, it's one of those typical controversies that happens in the industry. Ogilvy and Saatchi said they didn't actually take part in the pitch. They basically said they'd answered a brief and how they would execute it and did a meet and greet, but that was it. So NBR, after hearing of this, went to Harcourts to ask as to what happened, and Harcourts said, nope, all three agencies took part in the pitch, so there's a bit of he said, she said going on here. Contagion is a pretty outspoken agency, and it says if you answer a brief, then you're basically in a pitch. So overall, it's just sort of typical bickering between the agencies, and you'll see it a lot when you're covering this sort of round.
So what usually happens when an agency wins an account?
Yeah, well, what usually happens is either the client or the agency will send out a release saying such and such has won our account, and usually it's pretty fluffy. They'll say things like, oh, we're excited to be working with this agency or working with this client, and they leave out the sort of interesting details like what other agencies took part in the pitch. They usually do this because they don't want to, I guess, tarnish anyone's reputation and say they lost. But in cases like these, it's the exception.
They'd certainly be breaking out the champagne, I suspect.
Contagion will, that's for
indeed,
sure.
Indeed. Yeah, what kind of feedback did you get?
Yeah, so I had a few comments on the story from NBR subscribers, and there was a bit of divided opinion on it. So one subscriber said it was pretty unprofessional for Harcourts to sort of call out the other two agencies on this, and another said, well, Saatchi started it by actually coming out with a statement and saying we didn't take part in the pitch. Overall, though, I think it's, Adland's, it's never far from this sort of behaviour, and it's a highly competitive sort of industry, so it's no surprises to see it happen quite a lot, because it lives and dies by these sort of things. Account wins are what it thrives on.
Last but not least, in this week's edition of Media Watch, John Campbell's swan song on Friday night, TV3's 7 p.m. current affairs host, broadcasting for the last time. Any news on what's going to replace it, Nick? Obviously, in the short term, TV3 or MediaWorks has said Road Cops is going to fill the slot. And I noticed in the ratings on Monday night, Road Cops did not rate as highly as Campbell Live.
No, well, that's hardly surprising, actually, because ironically, the review of Campbell Live, which was all about correcting a long-term decline in the show's ratings, the review had a pretty much instantaneous effect on the ratings, making them spike in a way that they hadn't for many years. And as a result, Campbell Live has consistently been one of the top-rating TV3 shows during the course of the review, and continues to be so after the review is concluded and it was announced that Campbell Live is being axed. So yes, as you say, in the short term, which we understand is the next 6 to 8 weeks, the Campbell Live slot, 7 p.m. weekdays on TV3, will be occupied by repeats of a reality show, Road Cops, which essentially follows New Zealand police who are enforcing the law on the nation's highways. What comes after that remains to be seen, beyond the fact that it is going to be a current affairs show. Apparently the review revealed that there is an audience appetite for current affairs at 7 p.m. Mondays to Thursdays. Fridays there's going to be an entertainment show replacing Campbell Live in a couple of months. But as to the shape of this current affairs show, what it's going to be called, who's going to be hosting it, we do know there are going to be co-hosts, presumably one male, one female, and group head of news, Mark Jennings, has said that there is going to be a wider mix of stories in this new current affairs shows, which the more cynical of us have taken to mean fluffier and less possibly newsworthy items. However, look, I will make a bold prediction about what is actually going to eventually, the current affairs show that is eventually going to replace. There's a lot of speculation. I figure if I get in now, I can be possibly right for the next couple of months before being proven wrong. Okay, so my prediction is on the 8th of June at 10:30 p.m, a new show called Newsworthy is going to be launched. This is a replacement for Nightline, essentially, which was a long-running late-night news show that was replaced last year by a Paul Henry show, which was, of course, ditched when Paul Henry moved to mornings earlier this year. Now, Newsworthy is going to be fronted by Samantha Hayes, who also is one of the presenters of the current affairs show 3D, which new season started last Sunday on TV3, and David Farrier, who's been making quirky items for various news shows, including Nightline, for a number of years. Now, my prediction is that Newsworthy, after essentially being trialled for 6 to 8 weeks at the 10:30 slot, is going to be moved to 7 p.m. There are a number of reasons for thinking that. This show has been in development for a while, and surely it would be much easier and less risky for MediaWorks to move a show in the schedule to the much more valuable time slot of 7 p.m, a show that's had some time to develop. Because 6 to 8 weeks to get a new current affairs show fully formed and on air is going to be a big ask. So, yeah, that's my prediction. I look forward to seeing if I'm right or wrong in a couple of months.
We'll have you back and we'll talk about it again, Nick, I'm sure. And Campbell, thank you very much. That's this week's edition of Media Watch. Join us again next week.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
To market results, notwithstanding reporting a 37% jump in annual net profit and beating its own guidance, Labour hire group AWF Madison is reporting a slowdown in activity throughout much of regional New Zealand. Chairman Ross Keenan says it's a constant challenge for us to match the skills we've got with the jobs in the regions. He says AWF's underlying result was even stronger, up 45%, and that the white-collar Madison business delivered steady growth, but the core blue-collar AWF business delivered mixed results. He said it's just all over the place and inconsistent, and patterns of work requirements can change from month to month. For example, Rotorua was completely dead a year ago, but is now booming, while Whanganui and New Plymouth are slow. The slump in dairy payouts is also hurting, with Hamilton and Southland particularly affected. Mr. Keenan says still the first 2 months of the year have begun well for the blue-collar sector, and the Madison business is seeing a small increase on last year. AWF, which is the nation's largest labour hire company, continues to face labour shortages for builders, electricians and technicians, and it continues with an aggressive program of importing workers from the Philippines, which is working out well. But the company isn't facing any particular upward pressure on wages. It tends to work with the major contracting companies Downer, Fulton Hogan and Fletcher Building. It says margin tends to be the great challenge for us all the time, but we're certainly seeing no wage pressure. To our cash rate, Fonterra's latest payout forecast was not as bad as some feared, but it's still reason for the Reserve Bank to start cutting interest rates, according to a leading economist. The forecast update is for $5.25 per kilogram milk solids for the 2015-16 year, which was at the upper end of forecasts, but is still a significant drop on recent prices. ANZ Bank New Zealand Chief Economist Cameron Baggery says break-even is $5.90 to $6 for most farmers, and what people need to understand is that even if Fonterra comes out with a figure with a 7 in front of it, that does not flow through until 2017. There is a huge cash flow squeeze on in rural New Zealand, and the rubber only really hits the road in the next 12 months. If people think there has been a rural slowdown now, they haven't seen anything yet. Mr Bagri told NBR Online the Reserve Bank needs to cut the OCR now. There is no reason to wait and plenty of reasons to cut. It needs to help bring that exchange rate down. Other economists are less firm on an immediate rate cut, but say the risks are on the downside and the official cash rate, currently at 3.5%, is too high. First New Zealand capital economist Chris Green says because the OCR has stayed at 3.5% and others have fallen, there has been the kind of de facto tightening of New Zealand's monetary conditions. He says this Fonterra forecast is still below what the Reserve Bank expected at the time of its last monetary policy statement in March, and if this flows through into lower activity and lower GDP, it needs to be looking at lowering the OCR sooner rather than later. There are downside risks to today's number, and the prospects of early easing of the OCR are rising. Taking a different view is Bank of New Zealand senior economist Craig Ebert. He told NBR there's no need to pull the OCR trigger yet. You would do so if demand weakens, and we can't see much evidence of that. If wage and price-setting behaviour starts settling too low, then there would be a case, but that hasn't happened, especially if you look at that 2.7% rise in retail sales. What the Reserve Bank is worried about, he says, is if there is a new normal and the psychology around inflation goes soft, if people start expecting low wage and price rises. But he says we need to see the evidence of that before the Reserve Bank can respond. That takes any OCR changes to later in the year, if then. More results now. Arvida Group, the retirement village operator, which listed on the NZX last December, reported annual earnings in line with the prospectus forecast and affirmed its outlook for the 2016 financial year. Underlying profit, which Arvida said it will use as its primary earnings measure, was $4 million in the year ended March 31st, $100,000 below the offer document forecast. Net profit was $3.1 million or 1.37 cents per share, compared to a forecast loss of $2.3 million due to a bigger than expected increase in the value of its property portfolio. Revenue was $1 million above expectations at $20 million. Chairman Peter Wilson said in a statement, Arvida is performing well and in line with forecasts set out at the time of our IPO. This reflects the significant progress made integrating the 17 retirement village and aged care facilities and the benefits resulting from implementation of our support centre structure built to manage the group. The company raised $80 million in December, selling shares at 95 cents apiece to repay debt after bringing together a group of villages. The shares were unchanged at 91 cents today. The board declared a dividend of 1.03 cents per share payable on June 22 with a June 12 record date. The company intends to pay 60 to 80% of underlying profit a year on a quarterly basis. Mr Wilson said the board affirmed guidance from the offer document, which projects underlying profit to $13.3 million in the 2016 financial year. Mr Wilson said a number of acquisition opportunities continue to present themselves. Arvida will continue to investigate acquisitions opportunities that are accretive to the business. The company's growth focus is on brownfield opportunities, and it's seeking to source sites in areas with attractive demographics, including land adjacent to existing villages, according to presentation slides accompanying the result. As at March 31st, Arvida held cash and equivalents of $1.82 million and had drawn down $7.3 million of its $40 million bank facility.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
To People News, Sir Ralph Norris is to step down from the board of Fonterra Cooperative Group following its annual meeting in November. Sir Ralph joined the board in May 2012 as an independent director and said he made the decision because of his other commitments. He will also resign from the board of the manager of the Fonterra Shareholders Fund at the same meeting on November 25th. Fonterra said the board would initiate a process to identify a new independent director in consultation with the board of Shareholders Fund. Sir Ralph is chairman of Fletcher Building and on the board of Origin Energy and is a member of the University of Auckland Council and the New Zealand Treasury Advisory Board. He had a 40-year career in banking, serving as the CEO of Commonwealth Bank of Australia for 6 years and as managing director and CEO of the ASB for a decade until 2001. He left this role for several years to be the chief executive of Air New Zealand before leaving to head the CBA. Sir Ralph was made a Knight Companion of the New Zealand Order of Merit in 2009 and a Distinguished Companion of the New Zealand Order of Merit for Services to Business in 2006. Units in the Shareholders Fund fell 0.4% to 493 and have dropped 18% this year. In Tele News, Sky TV continues to take a surprisingly front-foot approach with its Netflix clone, the $20 a month Neon. The broadcaster said yesterday afternoon it will make Season 2 episodes of the cult hit True Detective available on its low-cost streaming video on demand or SVOD service. the same day they screen in the US. The series starts June 22nd. True Detective is the second A-list show to be sent express to Neon following Game of Thrones. HBO shows also screen on Sky's Soho channel. Sky TV has taken an assertive tack over the past year, signing multi-year exclusive rugby, HBO and Disney deals covering both broadcast and online rights. Launching Neon and its new fanpass.co.nz service offering weekly and annual subscriptions to sports content delivered online, and preparing a $120 million project to upgrade decoders for on-demand broadband content. However, there are signs that new competition is starting to weigh on the company. At an analyst and investor briefing earlier this week, Chief Executive John Fillett warned that programming costs were rising and that the company would have to draw down debt to maintain its dividend. Mr. Fillett said investors shouldn't expect the company to increase dividends as it invests to meet the challenges it faces.
This is NBR Radio, Thursday, May 28th. I'm Owen Poland. MYOB has signed an agreement to acquire Wellington company Ace Payroll Plus for $7 million. Ace stands to receive a further $7 million next year if certain conditions are met. Joining me now to discuss this story is technology editor Chris Keel. Chris, what's your take on it?
We've seen MYOB and its arch rival in Australia and New Zealand, Xero, both buying payroll companies. I think they're both looking to beef up their product sets so they can offer people more, and I think they're also both angling to be in the position where they can charge their customers more money per month.
I see that Ace is now the third company that MYOB has snapped up over the past 3 years. They bought Christchurch company Pay Global for $9 million and BankLink for $136 million. That's a fairly substantial, chunky investment in the industry.
It is, yeah, and it's created a couple of NBR rich listers in the process. So they've got a reasonable R&D budget, but they seem to be adding to their product set mainly by acquisition. So we'll, since MYOB recently listed on the ASX, we'll look to see if they buy any more companies, and they seem to have a penchant for buying Kiwi software companies.
How is the market digesting this latest development?
Looked just before, and MYOB's shares were up marginally, but it's probably not. It's too small a deal to impact the share price a lot. MYOB listed on the ASX just back on May 4, and its share price has drifted down a little bit now, but on its closing price yesterday, it still had a market cap of 2.1 billion Australian, which is roughly the same as Xero's market cap, so that's going to be a little bit galling for Rod Drury.
So, yeah, how do you weigh up this obviously ongoing battle? They both keep stepping up to the plate and going head-to-head, aren't they?
Yeah, in Xero's case, it's taking on MYOB in Australia and New Zealand, and then it's got sort of a multi-front fight, so it's got taking on Sage, the incumbent in the UK, and then in the US, it's taking on the big 800-pound gorilla, which is Intuit, which makes Quicken and controls most of the small business accounting software market there. And that's sort of why Xero has been acquisitive on the payroll front there, because it's with the 50 states, it's essentially dealing with 50 different markets with all of the different sales taxes. So that's been a complicated one for them there.
So do you see the market, just basically being carved up between them 50-50 in this part of the world at least anyway? They can both continue?
Well, they're both very fond of trashing each other. with in Xero's case, it does have a bit of a cleaner run at things, because it was founded quite recently and it's all cloud all of the time, whereas with MYOB, they're getting more and more cloud or online customers, but they still have this big chunk of legacy or desktop customers, and they have to spend money still developing software for them and a bit more to shift them over into the cloud. So they have a more complicated picture, definitely.
Fascinating battle, which we'll keep watching with great interest. Chris, thanks for your time. That's Chris Keel, NBR Technology Editor.
You're listening to NBR Radio. Upgrade to MyNBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
To a Fonterra update, Fonterra, the world's largest dairy exporter, has rejected criticism of its performance in communicating milk price forecasts, saying it's being as transparent as possible. The co-op today announced a cautious opening farmgate milk price forecast for the new 2015-16 season of $5.25 per kilogram of milk solids, while knocking a further 10 cents off this season's figure to $4.40, the lowest level in 8 years. ANZ Bank has suggested the dairy giant should move to publicly reporting its milk price guidance monthly. But CFO Lucas Pallavicini said Fonterra already gives sufficient transparency, publishing a global monthly update on market conditions that feeds into the milk forecast and informing the market of any relevant information that could affect the price. Open Country Dairy, the second largest milk processor, forecast its new season milk price at $4.75 to $4.95 last week. OCD supplier and Waikato Federated Farmers President Chris Lewis said its suppliers were fortunate that when information changed, OCD was the first to communicate to suppliers, updating it monthly or weekly if necessary. Fonterra said today that global dairy market conditions remain tough, with world markets oversupplied after farmers globally increased production in response to strong prices paid 12 to 18 months ago. The supply imbalance is heightened due to continuing good growing conditions in most dairy-producing regions. Mr. Pallavicini said there remained a high degree of uncertainty about how quickly world prices would recover as supply and demand adjust. He said, "We do expect to see progress in the demand and supply over the next 12 months, and for us it will be very telling what happens in the next 7-month period up to December." Federated Farmers Dairy Chairman Andrew Hoggard said the further 10-cent cut for the season will make it really tough for farmers managing their cash flows through the low winter months, given the likelihood of little or no retro payments helping to smooth out that cash flow. In football news, multiple officials from world football's governing body FIFA have been accused of rampant and systemic corruption worth more than $100 million in bribes and kickbacks over 2 decades. Media reports say US prosecutors indicted 14 people overnight, 7 of whom were arrested at a luxury hotel in Zurich by Swiss police. New Zealand is about to host the FIFA Under-20 World Cup, which kicks off this Saturday. The chairman of the organising committee for that tournament, Jeffrey Webb, is one of the FIFA officials accused. US Attorney General Loretta Lynch says the allegations relate to a dozen schemes involving FIFA officials, including 2 current FIFA vice presidents. One of the schemes relates to the awarding of the 2010 World Cup to South Africa. Former New Zealand football administrator Charlie Dempsey, who died in 2008, gained worldwide attention when he abstained from voting for hosting rights to the 2006 World Cup because of pressures from various people, despite having previously indicated support for South Africa. His decision saw Germany win instead. Those arrested in Switzerland face extradition to the United States, with Ms. Lynch alleging kickbacks worth about $150 million were received over a 24-year period beginning in the early 1990s. Ms. Lynch says they did this over and over, year after year, tournament after tournament. They were expected to uphold the rules that keep soccer honest. Instead, they corrupted the business of worldwide soccer to serve their interests and enrich themselves. 9 of the 14 indicted are FIFA officials, while the other 5 are involved in sports marketing and broadcasting. They could face up to 20 years in prison if convicted on racketeering charges. FIFA President Sepp Blatter, who's seeking re-election for a 5th term on Saturday New Zealand time, is not included in the indictment. FIFA says it will still hold its presidential election this week, despite calls from European football's governing body UEFA to postpone it. Swiss prosecutors also opened a separate investigation into the bidding process awarding Russia and Qatar the 2018 and 22 World Cups respectively. But FIFA is ruling out a revote on the awarding of both tournaments. Last month, the 2011 Rugby World Cup organising committee's former head Martin Snedden said New Zealand could strike a part-hosting deal for the multi-billion-dollar FIFA World Cup with Australia. Mr. Snedden said he believed co-hosting the tournament was a realistic goal given the success of the Rugby World Cup in 2011 and this year's co-hosting of the ICC Cricket World Cup. This week, Sky TV landed exclusive rights to the 2018 and 22 Soccer World Cup tournaments for an undisclosed amount. To market results again, Erode's maiden annual result as a listed company shows it missing its prospective revenue forecast, but for a reason that suggests a stronger business model. Revenue of $17.6 million for the year ended March was short of the $19 million prospectus forecast. Founder and Chief Executive Stephen Newman says that when it prepared the prospectus issued in July last year, his company had expected to be selling a lot more hardware in Oregon and North America. However, more customers than expected have preferred to rent the equipment on 36-month contracts than to buy it outright, and the revenue will be recognised over the life of those contracts. Mr. Newman says that has meant that revenue that could have fallen this year will come in over coming years. He says renting is absolutely our preferred model, adding that that's the model Erode is operating in New Zealand. The company, which sells technology to manage road user charges and other technology-based service for trucks, also missed its forecast units in which its technology is installed by 791. It came in at 23,915 compared with the 24,706 forecast. Mr. Newman says the company is about 8 weeks behind in Oregon. He says the bigger factor is that for February, March, April, our run rate is 500 units a month, which is in line with the PFI. The company had a further 1,947 contracted sales pending installation at balance date. Mr. Newman said, I think we're well placed in terms of delivering against our PFI for the coming year. Erode's bottom line, a net loss of $1.3 million, was also slightly higher than forecast $1.02 million and includes the $2.02 million costs of floating the company. The result, excluding those costs, is slightly higher than forecast. The company's customer retention rate of 99.2% is also higher than forecast 98.2%. Mr. Newman says Erode is very carefully measuring customer satisfaction to ensure the retention rate remains high.
NBR Radio with the Property Press. It's out now to show you around.
This is NBR Radio, Thursday, 28th of May. I'm Owen Poland, and welcome to this week's edition of Market Talk. I'm joined by NBR News editor Duncan Bridgman in the studio and Mark Lister, Head of Private Wealth Research at Craigs Investment Partners. Welcome, Mark. If we could start with you, Fonterra has announced that it's cut its season's dairy payout again by 10 cents to $4.40 per kilo of milk solids, and also announced an opening forecast for the next season of $5.25. How's this being viewed in the market?
Well, look, I think it's broadly in line with expectations. People were expecting, the real focus for a start, I guess, was on that opening forecast for the 15-16 season, and the market was expecting something starting with a 5, but not too far above that. So at $5.25, it's probably near the upper end of expectations. Now, that's obviously a little bit higher than $4.40 of the current season, but well below the 10-year average, which is about $5.85, and certainly well below the $8.40 that we saw a year or two ago. Now, I think it's quite important to note that this is just an opening forecast. You know, if we look at last year, we actually started out with a $7 forecast, and it was cut 5 times to end up at $4.40. If you go back a year before that, we also started with $7 and it ended up at $8.40. So things can change, and I'm sure they will change. So it's really just sort of an opening initial number, and we'll have to sort of see how the currency pans out and how global dairy prices go. But at the moment, it's reasonably in line with expectations. Duncan, what's your take?
Yeah, thanks, Owen. It is volatile, as Mark said, and I think that dairy farmers in particular are in for quite a tough 6 months or so, and it seems that any improvement in the global dairy prices is taking a while to come through. So any farmers that do have large amounts of debt are really going to have to tighten their belts, and this could have some ramifications in the regions. And they also need to maintain support from their bankers.
Can we read anything into Ralph Norris's rather sudden departure from Fonterra's board?
Well, I mean, it is a bit of a blow for Fonterra, but I mean, the reality is that he had numerous other commitments. He's chair of Fletcher Building, for example. So, this may have been on the writing may have been on the wall for a while, but it is a blow for Fonterra, as they need some strong leaders like him at this time.
Mark, the results season is now in full swing. We're seeing company results just pouring out of the stock exchange. What's caught your eye, and how are performances in general?
Well, the two big heavyweights this week are obviously Mainfreight and Fisher & Paykel Healthcare, and Mainfreight has already been not a bad result. Look, EBITDA was up 9% and bottom line profits are up about 8%, so it certainly wasn't a bad result. I think the company was a little disappointed with how the second half panned out. They obviously lost a little bit of momentum, and like a lot of New Zealand companies are seeing Australia as the weak link, which is a bit disappointing. But look, every single region of Mainfreight's business showed an improvement, and it's tracking reasonably well. Another one was Metro Glass. That was another interesting one. Obviously, the company hasn't been listed very long, so always interesting to see how these new companies go compared to their prospectus or their Pair 5 forecasts. Metro Glass beat its forecast at the bottom line level, but the sales level was a little bit weaker, and they were a little bit cagey when it came to the outlook. They refrained from giving any guidance for the first half of 2016 financial year, and said that they'll be in a better position to update the market at the AGM in August. So the market just sort of took that as a sign that maybe there's a little bit of uncertainty there, and the shares were down slightly. FPH will be the big one. That's another very large company. It's obviously had an outstanding run over the last few years. I think we've seen 8 profit upgrades over the last 2 years from Fisher & Paykel Healthcare. We're expecting it to come in at about 111 million net profit. Now, that's slightly ahead of the company's guidance range, but they do tend to be a pretty conservative bunch, and we wouldn't be surprised if we see them slightly beat the original guidance range. The New Zealand dollar is obviously a key contributor to how their earnings are going, and while they're quite well hedged for the current financial year, their hedging falls away a bit over the next couple of years. So while they might not get a full pickup from the lower New Zealand dollar against the US dollar this time around, it'll be what they say in terms of how that lower currency might factor into next year and the year after. So looking forward to that one too.
And of course, Moa still bleeding red ink.
Oh, look, it's been a rough ride, hasn't it, for shareholders in Moa, and I'd be hesitant to sort of suggest that ride's necessarily over. And I guess that's the risk of investing in companies that are at that end of the scale in terms of sort of verging on not quite venture capital, but certainly early stage investing. It's a whole different kettle of fish relative to looking at some of the bigger companies that are more established and have more of a track record. So it doesn't mean they're out of bounds for investors, but you certainly need to know what you're buying, don't you?
Duncan?
Yeah, we saw another sort of growth company this morning, Pacific Edge, announce its result, and also along with that a capital raise. So they are looking to seek up to 35 million from a rights issue, which they're pricing at 61 cents, and that's below the previous price before the announcement of 72, I think it was. So it'll be interesting to see how shareholders take to that on the back of the result, which is showing some revenue growth in its key US market, but it's got a sort of a long way to go. It's the company that does the cancer testing product out there. So that's one. And one other announcement this morning, Owen, was the Refining New Zealand. There was a block trade go through. Mark, you might be well placed to talk about that.
Yeah, look, I'll refrain from talking about the transaction specifically. We were obviously involved in that one, but essentially Refining NZ's a company that is on a pretty strong cyclical uplift. They've had this big expansion plan with a $360-odd million capital project to sort of expand the refinery. They're sort of coming to the end of that, so they're about $300-odd million through that, so nearing the end of that big spending plan. You've obviously seen refining margins go their way because you've had a stronger US dollar, you've had a lower oil price, which have helped them. We've seen them swing back into profitability, bottom line net profit of plus 10 million last year compared to minus 5 the year before that, and having not paid a dividend for 3 years, I think we think that they have a good chance of reinstating a dividend over the next, possibly within the next 6 months, certainly within the next 12 months. So it's a company that has been on the market and been around for a long time, but it has been out of favour with investors over the last few years and seems to be really coming right. So I think it's quite an interesting one to watch for the next 12 months.
You're listening to Market Talk, our weekly segment on the markets with NBR News editor Duncan Bridgman and Mark Lister from Craig's Investment Partners. Mark, can we just wrap this week's session up with a focus on the global markets? How are things shaping up with Greece, obviously the ongoing story?
Well, look, at the present time, markets are reasonably upbeat. Sort of on Greece, there was some positive signs that sort of came out overnight. But thinking about the bigger picture, look, from my point of view, I think Greece is insolvent. Literally, no matter which measure you use, and what they're really doing is delaying the inevitable. I can't see how Greece ever really gets into a position to be able to pay back its massive mountain of debt. So at some point they do have to face up to this and stop kicking the can down the road. I think the reluctance to do that, probably on the part of Germany and some of those other creditors, it really does open up a can of worms with some of those other weaker European countries that might then sort of think that they've got a reason to have some debt written off and so forth, if that's the way it plays out for Greece. But for the time being, markets appear relaxed about that issue, probably a little bit too relaxed. I'm sure we'll continue to hear more about Greece in the days, weeks and months ahead.
And that's it for this week's edition of Market Talk. My thanks to Mark Lister from Craig's Investment Partners and NBR News editor Duncan Bridgman.
NBR Radio. Free to air online with business news you can use.
To Christchurch, another new building in Christchurch's Victoria Street is scheduled for completion, and marketers are seeking tenants in an increasingly competitive leasing environment. The property at 167 Victoria Street is due for completion in late August. It's owned by Ashburton-based John Ackland and Blair Gallagher, who received an insurance payout for the former building, which was written off and demolished after the 2011 earthquakes. The building provides new space at the same time several other new office buildings are also coming out of the ground, although many of them won't be completed until next year. Incentives to tenants are becoming a feature of the market as the office vacancy level rises above 11% because of the new offerings. Victoria Street has become the heart of post-quake development in Christchurch, with more than 25,000 square metres of new office and entertainment space. Many law firms and professional services have relocated there, including Duncan Cottrell, Murray & Co and Craig's Investment Partners, as well as numerous cafes. The building will comprise 3 stories of office space and a mezzanine office on the top floor, plus 141 square metres of ground floor retail space. The top 2 stories have north-facing outdoor terraces with views down Victoria Street and over Hagley Park. Jesse Panger and Chris Harding of JLL are marketing the office spaces at asking rents of about $350 a square metre, with operating expenses on top, but MBR understands the owner is open to negotiation. Meanwhile, Richard Diver, whose name is synonymous with redevelopment of Victoria Street, is selling a 5,845 square metre block of bare land on Kilmore Street opposite Cranmer Square, formerly home to Environment Canterbury, which has continued to lease part of the site. Mr. Diver's Countrywide Property bought the land in 2014 for $7.5 million, originally earmarking it for a $75 million apartment complex featuring 2 towers above a 3-level car park. But Mr. Diver says he has his hands full with other developments and doesn't have time to do the proposed project justice. Countrywide Property still has several developments on the go, including a 5-level 7,000 square metre building at 123 Victoria Street, finishing a food court on the corner of Victoria and Salisbury Streets with an adjacent 54 car parks, 32 Oxford Terrace, a 5-level 6,000 square metre building due for completion at the end of this year, and redevelopment of the former Oxford Clinic site into a 8,000 square metre medical research facility due for completion in 2017. Mark McCauley, General Manager of Colliers, says the property is split into 3 titles with road frontages onto Kilmore Street and Chester Street West. Let's talk rubbish. Food and drink packaging make up most of the country's litter. The first litter survey in more than a decade by specialist waste consultancy group Waste Not Consulting shows more than 70% of New Zealand's rubbish comes from packaging for both food and drinks. Food packaging made up 37% of waste, while drink containers and bottles made up 34%. Public Place Recycling Scheme Manager Lynn Mays says one of the organisation's main performance aims is to reduce packaged litter 10% by 2020. She says the study will be a useful reference point for non-packaging organisations. The survey involved the counting and classifying of loose litter in 8 urban areas, including Auckland, Blenheim, Christchurch, Dunedin, Gisborne, New Plymouth, Taupo and Wellington. Examining an estimated area of more than 580,000 square metres, the survey found more than 18,000 items of litter. On average, there were 32 items of rubbish per 1,000 square metres. Industrial areas and arterial roads had the highest number of litter items, while car parks and waterside walkways contained the fewest. Ms Mays says the Packaging Forum will use the survey results to start work on improving performance. She says the Litter Snapshot found 87% of streets and public places surveyed were virtually free of visible litter. This indicates councils and communities are providing effective clean-up services. The real issue is how we change the way people think and act about litter. Ms Mays says New Zealand needs waste and recycling bins in the right places, and this is a major focus for the organisation. She says we need to look at programs that promote the unacceptability of littering and also work with local and central government on implementing litter control according to the powers set out in the Litter Act 1979. In market news, boutique brewer Moa is keeping a wary eye on its cash position as its growth strategy continues to bleed red ink. The company, headed by Jeff Ross, today posted a loss for the year to March of $5.6 million, marginally better than the previous year's bottom line. Revenue grew 32% to $6.1 million. Mr. Ross says the company had a deliberate strategy during the year to invest in growth. He said the craft beer category is a very exciting one to be part of, and we want to make sure we're in a strong position as it builds. However, the strategy put pressure on Moa's cash resources as supplier, and staff costs of $14.2 million outpaced receipts from customers of $8.8 million. After raising $5.5 million from a share issue last year, Moa had $3.8 million in the bank at balance date. In its results announcement, Moa says its board is conscious of the cash requirements of the business. While growing sales, improvements in cost efficiency and working capital are expected to provide enough cash to grow. The directors, it says, continue to monitor cash requirements and are prepared to consider sources of funding should it be required. Moa shares last traded at 32.5 cents, valuing the company's equity at $15.5 million.
NBR Radio with Hotel de Brett. Open for breakfast, lunch and dinner and everything in between. NBR Radio.
I'm Grant Walker with Last Call. Here's what's trending on NBR Online. Reaction to Fonterra's drop in milk price. Cameron Baggery says the Reserve Bank needs to drop the OCR now. The PM tells Auckland Council to get real. Arrest in football corruption scandal. MYOB buys New Zealand business. And Air New Zealand has a secret room, but very few of us will ever see it. To find out more on those stories, log on to nbr.co.nz or stay tuned. Those stories coming up next on NBR Radio. And now our results update. Shania Twain sang in 1997, "That don't impress me much." And it seems the market is taking the same approach to the news Gentrack may fail to reach its full-year prospectus forecasts. Auckland-based Gentrack, which develops billing and customer relationship management software for energy utilities, water companies and airports, released its half-year results this morning. In line with its forecasts, net profit rose to $3.2 million in the 6 months to March 31st from $2.4 million the same time a year earlier, while revenue increased 3.4% to $18.5 million. The company, which began in 1989 and listed in July last year, signed up a number of new customers, including the Glasgow, Aberdeen and Southampton Airport Group, Queenstown Airport and new Australian solar energy utility Go Energy. It got implementation projects up and running with Trustpower and Vector Lines, water companies in England and Fiji, 2 airports in England and Australia and another Australian energy company. However, management warned there were delays signing 2 major contracts under negotiation in Australia and the UK, which means it may not reach full-year revenue forecasts of $44.7 million and earnings before interest, tax, depreciation and amortisation of $15.5 million. Management will update the market as soon as there is more certainty, and if these projects cannot be included in full-year results, it expects Gentrack to produce a result similar to last year's underlying earnings of $13 million, according to Chairman John Clifford. But shareholders were not impressed, with the stock falling 4.5% to $235, below the IPO price of $240. Gentrack has stressed previously the risk that timing of large projects and contracts can impact results, and it's no stranger to this happening. The company shocked the market with a substantial earnings downgrade at the start of last August, just 5 weeks after listing on the NZX after an IPO that raised $36 million of new capital. The stock dropped 20% after Gentrack admitted several days after briefing analysts, which earned it a slight slap on the wrist from the FMA, a contract re-signing with an Australian energy utility had delayed. In policing news, the police investigation into allegations former MP John Banks failed to properly declare electoral donations was thorough and robust and not subject to political interference, the Independent Police Conduct Authority says. A report just released by the IPCA says it received 5 complaints from individuals not personally involved in the matter about the police investigation into Mr Banks. But Chairman Sir David Carruthers says it found the police investigation was comprehensive and thorough. In April 2012, police received complaints alleging Mr Banks failed to properly declare details of donations as required under the Local Electoral Act. The police conducted an investigation but decided not to prosecute Mr Banks. However, a private prosecution led to him being found guilty of knowingly filing a false electoral return in June last year. This was later appealed and the conviction set aside by the Court of Appeal in November last year with a retrial ordered. Last week, however, Mr Banks was acquitted of knowingly filing a false electoral return. A Court of Appeal panel of Justices, Alan France, Forrest Miller and John Wild, also cancelled the retrial order and said Crown Law had committed a serious error of process when it did not advance new evidence, now known as the Butler Memorandum. The IPCA says it has found the approach the police took in its investigation was reasonable. Sir David says the authority is satisfied from its inquiry and interviews that there was no interference or pressure on the investigation team from the police, executive or politically. Police concluded that they could not prove beyond reasonable doubt that at the time Mr Banks signed the return, he did so knowing that the particular donations were falsely recorded as anonymous. Earlier this month, the IPCA said it had completed its investigation and report but was unable to release its findings because of the ongoing court proceedings, which have now concluded. In business news, challenger ticketing company iTicket has signed a $400,000 ticketing contract with its first rugby client. Counties Manukau Rugby Football Union has assigned a locally owned ticket agency to look after the promotion and ticket processing for its home games this year. iTicket Managing Director Rhys Preston says the contract is a milestone for the private company because it marks its entry into major sports. He says the world of New Zealand rugby can be a tough one to break into. Many of the bigger unions have been tied into ticketing contracts for a number of years, so we just had to bide our time. Mr Preston says the incumbent ticketing agency was Ticket Direct. The contract will see iTicket process up to 30,000 tickets for Counties Manukau Steeler games in the season starting July 2015. iTicket specialises in online and mobile ticketing, box office software, outlet sales, as well as on-site services at events. It was founded in 2004 by Mr Preston and Phil Jobbins, both software engineers. The Newmarket-based company employs 12 staff and turns over gross ticket sales of $20 million a year. Mr Preston estimates his company has about 5 to 10% of the market share. The other 5 major ticketing companies are Ticketek, Ticketmaster, Ticket Direct, and Dash and Event Finder.
NBR
Radio.
Free to air online. NBR, the meeting place of intelligent business.
And now a Fonterra update. Fonterra has announced an opening forecast farm gate milk price of $5.25 per kilogram of milk solids for next season, while lowering its milk price for the remainder of the current season to $4.40. Along with previously announced forecast dividend range of 20 to 30 cents per share, the change amounts to a forecast cash payout of $4.60 to $4.70 for this season, which would be paid to a fully shared-up farmer. Rural economist at ANZ, Con Williams, says next season will be another tough one for dairy farmers' cash flow and that the reduction in revenue is going to mean some farmers' debt loadings will need to be bridged with seasonal finance. He says there's a lot of uncertainty about the timing of any recovery and the extent of that recovery, so a conservative approach does need to be taken. Mr Williams says currency and lower costs such as lactose are lower than last season and have slightly favoured the forecast price. Mr Williams says if you assume a very small, modest recovery in global dairy prices over the next 12 months, you can get it into that $5.25 range, which is what ANZ forecast. But in the bigger, broader picture, there are a number of shifts going on that look a little more structural for dairy markets, and it's unclear how they will play out. He says that some of these structural factors include Europe's increased production in milk powder, Russia representing a long-term net loss for global dairy import markets, corporate milk production reaching more of a critical mass in countries like US and China, meaning they are less reliant on imports, while energy and grain prices appear to be staying lower for longer, which is helping to reshape the cost curve. In a statement, Fonterra Chairman John Wilson said the revised forecast reflected the reality that global commodity prices had not increased as expected. He said if you assume a very small, modest recovery in global dairy prices over the next 12 months, you can get into that 5 to 5.25 range. World markets, he says, are oversupplied with dairy commodities after farmers globally increased production in response to the very good prices paid 12 to 18 months ago. This supply imbalance is heightened due to continuing good growing conditions in most dairy-producing regions. Mr. Wilson said this is a tough season and we will continue to keep our farmers informed as the season draws to a close given the current volatility. To Greece, experts in New Zealand and around the world are all unanimous when it comes to the looming question of Greece's debt repayments next month. They say it won't be able to front up with the cash. That is, Greece won't be able to make its IMF payments on its own and is in need of yet another bailout package. In fact, Greece's leftist-led government has been scrambling to unlock even more funds from the IMF to the tune of a reported €7.2 billion. If it's able to pull itself through June, payments to the ECB kick in July, with $3.5 billion owed to the European Central Bank in July, then a further $3.2 billion in August, not to mention the more than $8 billion it owes between June and August in short-term bills. It's a grim picture for the Greeks. Even the country's interior minister told media that a default on the June IMF repayment is likely. New Zealand Initiative Executive Director Oliver Hartwich says in the long term the chances of the Greeks defaulting is practically 100%. He told NBR Radio, given it's currently trailing at 175% debt to GDP and it has no economic growth, sooner or later something's got to give. But he says it's less about the money and more about what the other European countries are going to let Greece do. Mr. Hartwich says by looking at the figures, it's clear it should have gone bankrupt 5 years ago, but it didn't happen. It had nothing to do with Greece finding a sustainable path out of its debt load. It was because the other Eurozone countries were kicking the can down the road and giving Greece all sorts of emergency measures. He says as long as there is a political will and other Eurozone countries don't run out of money, Greece will stay afloat. Dr. Hartwich says if other Eurozone countries were wanting to just cut their losses, they would have been better off cutting the Greeks loose 5 years ago. If Greece had defaulted 5 years ago, he says, it would have been the private sector that took the hit. If it defaulted today, it would be the public sector. He says there are now hardly any private lenders that are still engaged in Greece, and the biggest player hit in the Greek default would now be the IMF.
This is NBR Radio, Thursday, May 28th. I'm Owen Poland. EROAD has just announced its maiden annual result as a listed company and shows it's missing its prospective revenue forecasts, but for a reason that suggests a stronger business model. Joining me in the studio now is NBR reporter and journalist Jenny Ruth. Jenny, what's that all about?
Yes, well, EROAD's had forecast it would make $19 million for the year ended March, and it came in $1.4 million short. But the reason is actually quite interesting. It had thought that its customers in Oregon, where it's just establishing a beachhead at the moment, would buy the equipment outright. Instead, it's finding its customers are preferring to rent the equipment from it, and the term of the contracts are 36 months. That basically means EROAD has got more insight into its ongoing revenue, because instead of just a one-off sale, every day you come in you've got to make a new one, it's got contracted revenue on its books now. So in some ways you could say that that's, even though it did miss the target, that's a preferable business model to be operating. It's certainly the way they operate in New Zealand, and I don't think it's necessarily a negative sign.
Who's it competing with in the marketplace?
Well, there are competitors in the marketplace, but they're relatively small. It's got about 30% of the market in New Zealand, and the service that it offers is automatically calculating road user charges. Most operators who don't use its equipment are still doing it manually, and you can see the obvious benefit of using technology to do something like that.
What's been the market reaction?
The shares were down slightly, but just under $4 today. However, the issue price was $3 a share, and they have never looked like trading anywhere near that. They've been well above that price ever since they started trading in August last year.
What about the outlook?
The outlook seems quite bright. Despite missing their target, for example, they had just under 24,000 trucks registered at balance date, and the forecast had been for nearly 25,000. However, they had nearly 2,000 sales made, but were still pending installation at balance date. So that is looking like it's tracking very well. Steve Newman certainly says that the company's well placed to meet the prospectus forecast for the current year.
That's great. Thanks. Jenny Ruth, NBR journalist.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
To politics and Auckland. Prime Minister John Key says Auckland Council needs to take a step back from its ambitious long-term plan and look at what its primary responsibilities really are. Mr Key told a property council breakfast the government is not happy with the council's plan to spend $500 million proposed for public transport over the next 20 years on heavy rail and a direct train between the city and the airport. The PM says the City Rail link, although expensive, needs to go ahead, but outside of that, the council needs to concentrate on spending money on building more local roads to provide infrastructure to greenfields housing areas where people will actually live. He says on the analysis the government has done, the council claims it will spend $2.4 billion on roading and public transport over the next 3 years. Even with the $2 to $3 a week levy on ratepayers and businesses, which is a fancy name for a rates increase, the council will only spend $1.9 billion. Auckland is growing at boom levels and the council cannot afford to be spending less on transport. The Prime Minister says the council clearly doesn't feel much pressure about these decisions, or not as much as the government comes under. He said it has to realise its main job is to provide infrastructure development and plan for it. While it's tougher on small councils with low rating bases, Auckland has a different scenario because it has greater capacity. He said when the government looks at its budget and spending, it's from the angle of what is expected of us. Auckland Council needs to sit back and do the same. It can't keep on increasing rates 9.9% year on year. It's too much for Aucklanders to accept. Auckland Councillor Cameron Brewer says the Prime Minister's comments back up what he's been saying for some time. He said there is no transport alignment between the Mayor and the government, despite what Len Brown says. Mr Brewer says the Mayor assured councillors at the Finance and Performance Committee last week there was greater alignment between the government and council on transport priorities and only a few little differences around timing remained. It seems, he said, the Mayor's targeted transport rate will be by no means temporary, despite claims it will only be for 3 years until Mr Brown convinces the government to allow motorway tolling. The Mayor has been publicly bumped again. There is no transport alignment. In business news, cancer diagnostics company Pacific Edge is asking shareholders to tip in $35 million to fund its US growth strategy and explore opportunities in Asia. After reporting $1.9 million of sales and a $10.7 million loss for the year to March, the company announced a fully underwritten renounceable rights offer at 61 cents a share. The offer is underwritten by First New Zealand Capital. Chief Executive David Darling says the company is pleased with the support from shareholders. He says this offer allows Pacific Edge to pursue its stated objectives and gives existing shareholders the opportunity to participate in the future growth of the company. In its results for the year to March 31st announced today, Pacific Edge says it has ramped up investment into its US sales and marketing team and increased the number of user programs in all markets, a critical element in encouraging clinicians to adopt its products. Most of the loss was the result of heavy investment in staff and product development, as employee and supplier costs ate up cash of $14.3 million during the year. At balance date, it had cash resources of $7.8 million. The sales figure represents growth of 1,208% on the previous year, and Mr Darling describes it as good progress. He said each step brings us closer to our goal of achieving gross revenue of $100 million by the completion of our 5th full year of trading. The bottom line loss was slightly more than the previous year's loss of $10 million. The company's core product is a bladder cancer detection product branded CX Bladder, which uses a urine test rather than a physical probe. It was launched in the US market in 2013. Mr Darling says the immense revenue potential in the US is its primary focus. In business news, MYOB has signed an agreement to acquire Wellington company Ace Payroll Plus for $7 million. ACE stands to receive a further $7 million next year if certain conditions are met. According to Companies Office records, ACE is 90% owned by Julian Ericsson and Philip Ericsson. MYOB refused to detail ACE's revenue and earnings, but Chief Financial Officer Richard Moore did tell NBR Radio it is a profitable business that will be immediately accretive to both our earnings and earnings per share, although the timing of the deal will mean the first half earnings impact will not be material. Due to the sizable overlap with our existing MYOB client base, the increase in our number of paying users will also be small, but it will help bolster our ARPU, or average revenue per user, in New Zealand. And it will deepen our relationship with many New Zealand clients, as we will now provide them with both accounting and payroll software. ACE is the third New Zealand company the Melbourne-based MYOB has bought over the past 3 years, following Christchurch company Pay Global and Auckland-based Banklink. MYOB competes against the globally focused Xero across Australia and New Zealand. Both companies have bought payroll software providers recently to beef up their offerings.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
To the energy sector, oil company Chevron New Zealand, operator of Caltex service stations, is selling its holding in the Marsden Point refinery. Chevron's 11.4% stake in New Zealand Refining is being sold by broker Deutsche Craigs through a book build. New Zealand Refining shares have been placed on trading halt until the trade is complete. At the last market price of $2.52, the stake will be worth about $89 million, although it's likely to be sold at a moderate discount. Buyers are likely to be institutions and private investors. Deutsche Craigs says it's agreed to purchase the stake for at least $2.32 a share under a block trade agreement and will underwrite the sale. In an announcement to the stock exchange this morning, New Zealand Refining says the sale does not affect Chevron's fuel processing agreements with the refinery. The other main shareholders in New Zealand Refining are BP with 21%, Mobil with 17% and Z Energy with 15%.
This is NBR Radio, Thursday, May 28th. I'm Owen Poland, and joining me in the studio is Primary Industries reporter Jamie Ball to talk about the latest announcement from Fonterra, who says an opening farm gate forecast for its milk price next season is $5.25 per kilogram of milk solids. It's also lowered its milk price for the remainder of the current season to $4.40, that's 10 cents down, along with its previously announced forecast dividend range of 20 to 30 cents per share. The change amounts to a forecast cash payout of $4.60 to $4.70 for the season, which will be paid to a fully shared up farmer. Jamie, what do you make of this announcement?
In short, I think there's a collective sigh of relief across analysts who've been fearing today for many, many weeks. We've known for quite some time, really at least since Christmas, that next season is going to be the bogeyman in terms of the dairy industry, that we will get through this season no matter how difficult the season has been, but next season could be the killer, so to speak, and drive many farmers to go bankrupt. But really what we seem to have got through it as such with this announcement today, that it's very, very early days, and it has to be stressed that usually it is first of all, it is just an estimate, and it will change hugely through the season. So we'll be talking maybe this time next year and it could be radically different. But at this stage of the game, I have to say there's a feeling of relief because it could have been a lot worse, and that was immediately felt in the dollar.
No doubt analysts are poring over this forecast, and I understand there is some concern about seasonal conditions going forward.
Yeah, the manner in which it's structured, in which payments are withheld so that farmers can be paid after the season, usually from about July to October, they're effectively overpaid early part of last season, as it turns out. So there's very little payment coming through in the spring. Now, the spring is the most costly, apart from obviously being the busiest time. It is peak season in the dairy industry. It is all systems are go. It's also the most expensive few months. So there is a potential cash flow, I won't say crisis, but major issue that we could be looking at around August, September, October, which really will need to be addressed through financing or bridging loans, or perhaps some other remedies.
Normally the Fonterra Shareholders Council has something to say about these announcements. What's been the reaction there?
Yeah, well, I have to say over the years the Shareholders Council has often been perceived by some farmers as being cheerleaders, the Fonterra Fan Club as they're nicknamed. It was good to see them actually come out in an announcement announcing their own feedback to the release this morning. But in generally, they described it as saying farmers would be cautiously optimistic, which I think is a pretty accurate summary. But what I think a lot of farmers and analysts would be pleased to see is that they've also begun knocking publicly, at least in a transparent way, on the doors of Fortress Fonterra in terms of communications, which haven't always been as forthcoming in the past as we'd like to. The chairman, Ian Brown, has noted, he said, while acknowledging this volatility, farmers will be expecting their co-op to communicate any significant price fluctuations that occur throughout the season in a transparent and timely manner. And I think that announcement is very timely in light of what we discussed in recent weeks.
Thanks for that, Jamie.
NBR Radio with the Property Press. It's out now to show you around.
In results news, TRS Investments, the company that was to have been the backdoor listing vehicle for Kin.com's Mega, has reported a $53,000 net loss for the year ended March. That's up from the previous year's $33,000 net loss, and the company attributes the increase to costs associated with the failed Mega transaction. The company, which is now looking to become the backdoor listing vehicle for another company, had negative net assets of $221,000 at the end of March, including $202,000 owed to Mega. The company has previously said it will issue a yet-to-be-decided number of shares to satisfy its debt to Mega. The Mega transaction was first proposed in March last year, and earlier this month, TRS finally acknowledged it was never going to happen. In March this year, PayPal stopped processing payments to the cloud storage service, making it difficult for Mega's customers to pay for the service. That cast doubt over Mega's future, although it said at the time it was seeking alternative payment options. PayPal's action was prompted after Mega was named as not being a legitimate cloud storage service in a report by the British-based online brand management agency NetNames. Mega continues to rebut accusation that it's a platform specifically designed to enable the mass infringement of copyright and to share illegal content. Earlier this month, Mega Chief Executive Graham Gaillard said the company was taking legal advice over these allegations. To Wellington Airport. Opponents of the Wellington International Airport's mooted $350 million runway extension are just a small minority, according to Chief Executive Steve Sanderson. The airport, which is owned 66% by NZX-listed infrastructure investor Infratil and 33% by Wellington City Council, wants to extend the capital's only runway to attract more long-haul international Asian and North American routes as the domestic market grows increasingly competitive. The city's council yesterday approved the inclusion of a $90 million contribution to the extension in its 10-year plan. Speaking on Tuesday at a Wellington Chamber of Commerce breakfast, Mr Sanderson said that if the extension goes ahead, one direct or long-haul flight to a major hub would be worth about $3 to $4 million in revenue to the airport company in the first few years. That doesn't quite tie in with a $350 million investment if the airport were going to actually pay for that in its entirety, which is why the extension would need further public funding. The company has previously indicated it expects central government to assist with the project. Mr Sanderson said, we're talking about public funding and we're also talking to the airlines. The current incumbents have said they don't want to pay for an extension, and we've said that it will be user pays, so the current incumbents won't pay for it, referring to the airport's main users, Air New Zealand and Qantas subsidiary Jetstar. The funding for it does require, he said, some funding from the airport and some funding, or the majority of the funding, from the public. Mr Sanderson said he understood at least 80% of the Wellington Chamber of Commerce's 3,000-strong membership were in favour of the extension and wanted them to support the plans, particularly when it goes through a resource consent process. The airport has applied for the project to be fast-tracked as a project of national significance, meaning the application would be administered by the Environmental Protection Authority. A report by accounting and consultancy firm EY released last year found the extension would add between 16 and 33 extra flights a week by 2060 and would lift Wellington's connection to long-haul destinations and flight hubs in Asia and America. The report doesn't provide a cost-benefit analysis, but calculates in the best-case scenario if the economic impact would bring an additional $970 million to the Wellington region and $1.7 billion across the country. A countering report commissioned from the New Zealand Institute of Economic Research for the Board of Airline Representatives of New Zealand, representing airlines currently operating in this country, was highly critical of the EY analysis for failing to include a cost-benefit analysis. Mr Sanderson expects a cost-benefit analysis for the plan to be finished in a month's time. The airport will begin public consultation in August and file its consent with the EPA in the last quarter of this year, assuming it's cleared for that process. For a hearing in the new year, he said that would lead to a decision some 6 to 9 months afterwards. To property and tax. The Property Council says the budget's tax policy did nothing to fix the deeply problematic issue of earthquake strengthening for thousands of property owners and businesses around the country. Building and Housing Minister Dr Nick Smith has reduced the number of buildings requiring assessment from an estimated 500,000 to 30,000, and owners who have to carry out earthquake strengthening will be given more time. However, Property Council Chief Executive Conal Townsend says the country's tax laws don't treat strengthening work fairly. He says the government's risk-based approach to the issue is good, but the fact is that the costs remain an issue, especially for our smaller towns and those in high-risk zones. Mr Townsend says commercial property owners cannot claim tax on carrying out life-saving upgrade work, but can do if their building collapsed and killed people in the event of an earthquake. It doesn't make sense. Mr Townsend says the Property Council would have liked the government to amend the tax laws within the existing policy framework to explore options for property owners when they're suffering major economic losses associated with upgrading. He says tax laws also fail to account for a significant portion of heritage-listed buildings that require upgrading but are owned by tax-exempt entities such as charitable trusts. He says these owners will definitely fail to upgrade many beloved community buildings if some kind of non-fiscal measure is not offered to them.
NBR Radio with Hotel de Brett, partying since 1959. www.hoteldebret.com. NBR Radio.